Hey everybody, and welcome back to the LAGFX channel. Today I'm going to be actually remaking a video that has been on the channel before and has recently been getting a whole load of traction. So obviously people are really enjoying what's being provided and enjoy seeing this analysis technique, which is the 3-box strategy. So this is actually courtesy of LagfX, who is somebody who I learned it off, somebody that first, or as far as I'm aware, first implemented this idea of analyzing the markets with a set technique like this, which I think is extremely rational and honestly just the best way to go about it, to have this strict criteria when it comes to analyzing and understanding that we must see 1, 2, and 3, or each color of each box within a setup in order for us to get entry confirmation, in order for us to load up on positions in that area in the market. So what I'm going to do is I'm going to dive straight in. I'm going to show you some examples, show you how I now use it, which may be different from the last video because we are months down the line from that last video, and obviously my trading, as everybody else's does, no matter how advanced you are, it's always improving time on time as we enter different market phases, so on and so forth. So what is the 3-box strategy? Well, it's understanding that there is 3 steps to our strategy. My integration of the smart money concept strategy has 3 different things that I want to do. So 1 is going to be understanding and interpreting market structure. And what that means is that we are going to do a top-down analysis on a market to give ourselves a bias, establish a story of what price is wanting to do longer term. And then as we go down the time frames, we can understand how that higher time frame bias and how the desire of price structurally on the higher time frames is going to dictate what we want to see on the lower time frame. So first box we want to find is an impulsive wave. Of course, the trend is our friend. We want to be on the same side as the market is currently trending in. So the first thing we'll do is identify an impulsive wave in the market, understand, right, we recently had, for example, a bearish impulse down. We are now seeing price deliver a correction wave. We've started breaking higher. Therefore, what we want to do is try and find a way to get involved at the start of the new impulsive wave, as that is going to be the best possible place in that market to get involved in a position. Secondly, it's understanding, well, when that correction wave begins to form and we start to trade back up, if it was bearish in this example, we are understanding, well, where within that impulsive wave is price most likely to trade up to before reversing. And what we can do is we can find unmitigated orders left over in that impulsive wave that are going to attract price towards them, because the orders left over in that region need to be mitigated. Now, again, using that bearish example, there's going to be a buy order or potentially going to be multiple buy orders left over in that impulsive wave. And when price comes and taps and mitigates that buy order, therefore removing that buy order and therefore removing demand from the market, it allows the supply and demand balance to shift back again into supply's favor. So what we're saying is this region in the market is acting as an area of interest or a point of interest that we believe when price trades up towards it, or if we were bullish, trades down towards it, when it hits, it's going to hold reversal power. And then finally, number 3, that is understanding Wyckoff schematics or any form of entry confirmation that you want to use. Okay, well, price is now tapped into that point of interest. How can we find confirmation that we are definitely reversing here? Because yes, price may just tap, but that doesn't mean that price isn't going to fall through that zone, do something different that we cannot predict. How can we view what happens in that region to decide, okay, that is exactly what we need to see in order to enter a position on the market? So that is 1, 2, 3. That is 3 things that we need to see. And now I'm going to show you their implementations in the live market. So as I stated, we're probably going to be doing this on a top-down or integrating a top-down analysis first. So I'm going to quickly run through a top-down. So we're understanding structural points. So we have a swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low. Now, each one of these, because we know it's bearish, because the lows are being broken, highs are being protected, we can say, right, let's actually draw out every single impulsive wave within this bearishness, which is exactly what we'll do here. Now, We don't really need to worry ourselves about what's happened in the past because we can't trade that, it's already happened, but we can worry about what's happening right now. We see again, price penetrated the low, creating a new lower low, therefore this was a correctional wave. This was an impulse, and we can see price is now delivering that correctional wave back up. Now, as we can see, what we would want to see in order for price to remain bearish, but the first thing that we can say using Wyckoff's laws of a supply and demand analysis, we can say, well, evidently, back here, our impulses were very high volume candles, high volume, high spread candles. Correctional waves were very short. As we've entered this region, the impulses are losing volume and spread and taking much longer to be created, and the length of the impulses are shortening. So seeing this impulsive wave, I can see, right, well, we've not had a clear drop straight down. The bearish candles are not of high volume and high spread. It's taken a long time from price to get to A to B, and we have only broken the previous low by a very, very small amount. So all of those three things are indicating to me that the current trend may be coming to a close. And that is using a simple supply and demand and volume spread analysis, understanding when a trend is beginning to lose control. So what I am going to say is that potentially what's happening here is that the market is reversing. So we can assume now, moving forward, that this should be the start of bullishness. So using that assumption I've made, which is something I think we should all have the knowledge to do and all understand, when we look at a trend, how can we predict the end of that trend coming? If you're familiar with Wyckoff schematics, you may then have been able to say, well, this actually does look like an accumulation, coming down into buying climax, automatic rally, secondary tests in this region. We have the spring coming to manipulate all of the liquidity in this area. And then we see price starting to take off. We have that last point of support or a reaccumulation, and then price begins to take off. So using a supply and demand analysis, volume and spread analysis, understanding that the trend is likely to come to an end, and then identifying the fact that this is likely a Wyckoff schematic, we can now say that it's likely this is bullishness. So using our 3-box strategy again, simply just using the very first one as of right now, we can identify 2 impulsive waves on this time frame. Now, just a quick insight, because we could have said inside of here, well, where would we then identify the second one? Well, we're looking for sell to buy orders that are yet to be mitigated. So this entire region represents sell to buy. Therefore, we can get our point of interest there. Another region is in here, where we see that we have price pushes back up. And then from here, we sell down. And then from that level, we see nothing comes back to penetrate this level. Now, the reason why here I've taken the whole region and I haven't here is because the wicks would indicate that the actual final sell to buy is in this region right here. So we see that price is tapped into this sell to buy region. We've then seen the reversal. We've then gone higher. Now, if we go slightly lower, we can see that we have had entry confirmation, because the 3 things I look for when it comes to entry confirmation is A, see liquidity get built up. That's exactly what's happened in this region. These 3 taps just above the zone represent an area of liquidity. We then see a high volume push through to clear liquidity. So that is the second thing we need to see. And then if we were to view this structurally, this right here should have been a protected high. So the second that we have been delivered with all of that, we have been delivered entry confirmation. The second price surpasses this level and breaks the high, that delivers us with a change of character or a break of structure, which is confirmation in itself that the market is reversing, the trend is over, and a new one is prevailing. So there alone, we've had each 3 steps. We've identified an impulsive wave inside of the trend that we believe is prevailing overall in the market, then identified a region in the market itself where price holds relevance. So we understand there's an order in here that needs to be mitigated because of the fact that we have an order left over. What's going to happen here is we tap in. The mitigation of that order is going to introduce demand or remove supply from the market, therefore allowing price to make that move up. So now looking inside of this, we can see that price is still continuing with this impulsive wave. So at times like this, it's going to be quite tough because our strategy isn't really worth anything until we are seeing a correctional wave, because we are getting involved at the end of a correctional wave or the start of a new impulse. So there's not really much we can do on this time frame as of right now, because we are still within the creation of a impulsive wave. We can, however, begin to go lower and actually look inside of this. For example, what's happened recently, where we can see we've had impulse, and let's make sure those are the right colors. Another impulse up, and then finally where we are now, another impulse up once again. So those are our impulses. Now we can see that price is tapping back into unmitigated orders. So we see that this wick would represent a hidden demand zone. Now, if you're not familiar with that, it's understanding that yes, we tell people to look for like a last sell to buy, last buy to sell. But if we use what the wicks are telling us, we know that, well, what's happened is prices come up and then traded back down. And then from here upwards, we've had high volume, market inefficiency in between. So I'm not sure if price does tap this exact region, but that wick, that very small zone there, would represent to me a hidden demand zone. Everything else seems pretty much mitigated. That taps into there, that taps in, and I'm just following the wick. So there's potentially some things lower, but obviously we've seen prices already reacted to that. Now, let's quickly just go down to a lower time frame. Let's see if we would have been delivered any form of entry confirmation. So remember what I said I wanted to see. Liquidity built up, so these lows would represent an area of liquidity. We have many wicky rejections from this region. Liquidity, and then we have this candle here represents the high volume push through. So that is number 2 of what we need to see. And then at that point, this high should be protected. So the second we break that high, we understand we've had a change of character, break of structure, and there, right there, we have been delivered with step 3, entry confirmation. Now, you may decide to, and I actually did this in the last video, was I used Wyckoff schematics, so understanding we would have silent climax, automatic rally, secondary test in this region, a spring, a test of the spring. As we move up, we have a last point of support, a last point of support, last point of support, we leave the trading range. Yes, we could sit here and identify every single event and phase in a Wyckoff schematic, but I have a very simplified way of understanding when a schematic is forming and when a reversal is valid. As I've stated many times, 1, liquidity built up. If it's a demand zone, liquidity built just above that zone. B, we want the high volume push through liquidity to come and mitigate the zone. And then finally C, we want to see a change of character, therefore giving us confirmation that the trend is in jeopardy. So there, right there, we have been delivered 1, 2, 3, and we would have been able to find an entry in the market. And this just ensures that we're waiting for all 3 things to be delivered to ensure that the probability of the trade playing out is as high as we can possibly get it. Let's now zoom back out. We'll go to the time frame we were on, which I believe was a daily or a weekly one before. Not too relevant. What I'm seeing here, though, is the fact that right off the bat, we can see a sell to buy candle right there, which price tapped into. Does it tap in fully? Well, I may be wrong there because price doesn't actually tap in, which is completely fine because this is going to happen in the market. It's not every single time that we identify our points of interest is price going to tap. So potentially in that moment, we wouldn't have been able to catch a position. That's absolutely fine. Now, let's analyze the most recent impulsive wave, where price is as of right now, and let's see where we would identify. Well, firstly, we have a nice sell to buy using the wicks in this region, which is close to price. We have inefficiency straight after, liquidity built up already, so it could be quite nice to see a tap into there. And then following all of this, this is quite tough because there could potentially be a lot of unmitigated orders in this region. But we just follow the wicks. Seems like I'd also identify this zone as a major sell to buy region with inefficiency after. And then it appears that after that, there's no other, I would say, major play. So these are the 2 zones I'd be watching. So now, as of right now, on the daily time frame, we can set our alerts here, 140.743. We can set an alert here at 137.134. If it's going to let me add the alert right there. And all we're going to do now is wait for price to trade down into these when price taps in, looking for liquidity to be built up just above the zone, high volume move to clear that liquidity, and then see price deliver a break of structure or change of character to the upside. Now, we can do this on a range of time frames over and over and over again. I mean, for example, right here, we could be saying that, okay, well, following bullishness, we had an impulsive wave here, came down. So what we're saying is that even in terms of the fractal nature of the markets now, we could say that this was an impulse. Okay, this would have been a point of interest within that impulse, potentially alongside one of these as well, that we could have identified in the moment, which we see price actually did have a small reaction to. Let's just change that to a zone. And now we would go down to a lower time frame to see if there was any form of entry confirmation delivered. Now, there is no clear schematic in this region on that time frame, but if we go low enough, if it lets us, we can see that on the actual tap, we have had liquidity built up on this fractal time frame, liquidity cleared by this high volume push from here to the bottom. And then when that happened, this should have been a protected high. So the second we're delivered with a change of character or a break of structure, like we've been delivered there, we understand that now we've had that entry confirmation inside the zone. So that is 3, and our entries are valid. But a point that is worth noting is that the way that you want to enter in on that market moving forward is completely up to you. Whether you decide to enter in the second you have that break of structure, or whether you decide, okay, let's use the 3-box strategy again and decide, right, well, this is an impulsive wave. Okay. Inside of this, we would have been looking at this as a last sell to buy, which is clear because we've had a sell down and then market inefficiency straight afterwards, a high volume push up. And then looking inside of here also, the lowest region that has been left unmitigated would be this right here. We can see that again, price is tapped into that region, and I wonder if it'll let me replay lower. I doubt it. I doubt it'll let me to a 15-second, but we'll see. And inside of here, it appears, okay, fair enough. No real entry confirmation. Each time we tap into a zone, there's not always going to be confirmation. So this is where the strategy does have its flaws, because not every single time we tap into a zone is there going to be a clear confirmation or a clear reversal in the market. In this case, there hasn't been. And then on top of that, it's finding, okay, well, once we've been delivered the first set of entry confirmation, once we've been delivered 1, 2, 3, which we were delivered, if you remember correctly, on the higher time frame, impulse, identified, correctional wave back down into a point of interest, and then on the 1-minute time frame, we've identified this region here. So what we'd want to do is we could potentially get involved straight after the change of character, stop loss just below the low, and then take profit all the way up at the market high, which we understand is likely going to be all the way up here, right? Let's just zoom out. Yeah, all the way up here. So we still got a 6.5 RR trade there. Or, as I was stating before, what we could do now is we could just keep following this market, doing the same thing with a 3-box strategy on a lower time frame until we potentially or eventually see something that we can enter in from. Now, it all depends on the phase of the market. You know, we could just keep following, saying, okay, we have a new impulsive wave formed. So the second the previous high is broken, we know that a new impulsive wave is being created. We understand that as soon as price starts delivering a correctional wave, okay, that's confirmation. Where might price want to come down to? Okay, well, it appears we have a last sell to buy in this region. Is there anywhere else? I mean, potentially inside of there, but price has already tapped through that. And if price does eventually trade us down into there, maybe we manage to find an entry. Maybe we don't. But the fact of the matter is, you have 2 options, whether you get involved the second you gain entry confirmation on one time frame, or whether you use a range of time frames within your analysis to gain a more refined entry, in which case, once the first set of confirmation is delivered, like we're doing here, we then go down to a lower time frame, do the same thing, and wait until price eventually delivers us with some confirmation. Now, the downside of refining like we are here, as you're seeing, you know, I could be waiting here for days until eventually price pulls back into these zones. The reason why is because once we're delivered that higher time frame reversal, that means that the institutions have already loaded up on a whole load of positions. They're ready for the market to reverse higher. We have a lot of volume, a lot of volatility to the upside now. Therefore, finding these deep pullbacks into zones becomes less rare. So you can either get involved straight away, have a less refined entry, but a higher probability of being involved on that winning trade, or we look to refine the entry, in which case we gain a better trade with a higher RR, but it's less likely that we actually find the entry. So I'm just going to insert this clip here for you all, and this is probably a week in the future from when I actually recorded this video, the 3-box strategy video. Now what I'm going to do is I'm going to update how prices played out since we made that video and show you how we could have gotten involved in this market in the coming days, if not the coming weeks, given that one higher time frame reversal we've had, where we had that 3 box delivered. So we had the 3rd box, Wyckoff, or some form of reversal, which, if you remember the process we've just gone through to identify that, as price started to take away, I'm sure you'll remember me saying that what we need to do now is keep finding these impulsive waves on the fractal timeframes, looking for those pullbacks and looking for the same thing again. And I'm going to show you examples of how we could have done that as price prevailed upwards. So, as I stated, the first thing we could do is just get involved simply after the change of character is delivered. Stop loss below the low or below the zone, wherever you decide is appropriate. And then take profit, of course, is going to be all the way at the top of the market where we have our final target, some 500 pips away. So that could be a position we got involved with, by all means necessary, or we could have done what I've done here and keep going through. So I remember when we went through, there was no entry confirmation in that. This is a higher time frame sell to buy. Let's see if price taps anything into that. Okay, yep, we have a tap. If we go down to the lower time frames on this, we can see what has been delivered. Let's just replay that. So we can go down to a 15-second. And what has been delivered, exactly what we need. We've had liquidity built up just above the demand zone. Okay, so we've had liquidity. We've had a high volume push through to clear that liquidity. And then we have that break of structure or change of character delivered. So what we could have done at this point is entered a position here, stop loss just below once again. And what you will see is that this time around, the stop loss, I believe, on the last position we were looking at, if we got involved in the first major change of character or break of structure, was about 70 pips. This one is 14. So if we now just go to the 1 minute time frame, we understand how we could have got the entry there. And let's move this take profit all the way up to the final target up here. That is going to be a 28 RR return if price was to play out. Of course, we'd partial along the way, so on and so forth, but we don't need to delve into that. And we'll also take off the replay, because we can see that many times we have had price tap in 1, 2, 3, 4, 5, and 6 as of recent. We've had 6 opportunities where we could have gotten involved in the market. We see again here what's happened, and let's go to a lower time frame once again. In this example, go to a 30-second. See a lot of liquidity built up this time in this region. Price comes down to tappers into that range. You'll see that what happens if we were to view this more fractally, this should have been a protected high. That high is broken. We then identify a further zone down here, this last sell to buy region. Price taps in. So in this case, we could have gotten involved in a position here, stop loss just below that zone. I'd usually always add a pip or a couple pips. So let's just say we'd add 4 there. This time around, we have a 4 pip stop loss. So again, when we move this position higher, and another point is we could have found another entry there on top of all of this, but we get too carried away. Let's take this up now. A 55 RR trade there, and that was accounting for spread, where we added an extra pip, 2 pips on the SL, and that right there, 55 RR. So there are options when it comes to tackling this market, And that's just a couple of them. You know, we've had another one here, which is a prime example again, where we've had liquidity built. Price comes back through, change of character delivered, tap into a last sell to buy. So again, another opportunity for us to get involved in a buy there. So this should hopefully all make sense now. Once we delivered those 3 boxes, so once price tapped into that overall demand zone we were waiting for and looking at, yes, we found Wyckoff and entry confirmation here, and we could have gotten involved on the change of character instantly, or we can try to integrate a whole new round of the 3-box strategy into that, in which case we looked for, let's choose an example which we saw, this one here. We identified the impulsive wave, we identified a sell to buy region, we then see that price came down, and if you remember correctly, we went down to the 15-second here, so we went down to a lower time frame, we found entry confirmation, so we got that 3rd box delivered, and this time round, the second we're delivered with the break of structure, we can get involved in a position. It is much more refined, and as price plays out, we can find multiple entries, and that's what I was saying in the case where we can load up on positions in that one higher time frame move. So where we may decide to just get involved in one position on the overall entry confirmation delivered from the overall 3-box strategy that we did, or we can look to also integrate more fractalized implementations of this analysis strategy and keep adding in on positions. You know, I said that we had maybe 5, 6 reversals from demand zones here. Maybe not all of them delivered entry confirmation, but let's say 3. I think we went through 3 that delivered entry confirmation. We could have gotten involved in 3 positions in this region, 3 profitable positions with more refined entries, or we could have got in 1 position with a less refined entry. So this is the importance of not only implementing the 3-box strategy into your analysis, but doing so, integrating fractalization within that. So it's so important that we integrate the use of a range of timeframes to allow us to A, get involved in more positions and therefore be potentially more profitable, but B, to refine those stop losses so that we have a higher RR return trade. Now, the reason why this is so important is because for us, what we wanted to do, and when something plays out on the higher time frame, you know, we could be waiting for the higher time frame move. I believe I actually got rid of the blue box here, apologies. We had been waiting since the creation of this impulsive wave, so the 7th of September, all the way to the 22nd, okay? So that is 15 days off the top of my head, 2 weeks. That is 2 trading weeks we have been waiting for one opportunity to play out. So why would we just wait 2 weeks to get involved in one position? Instead, we have waited 2 weeks. Let's load up on positions. And you know, this is the tap 22nd to now. So we spent an entire trading week then loading up on positions until price eventually reaches that target. And again, we'd then potentially have to wait a week or 2, price to trade back down into a zone and then spend another week loading up in position. So do not be afraid to go an entire week without placing any positions. That is completely normal. It is completely fine. Sometimes we do just have to be patient, wait for these higher time frame moves to play out. And then when they do, we can spend time loading up on those positions and capitalizing the most we possibly can through the use of patience. So just wanted to throw that in so that that part of the video would make more sense and I could come back and update you all, but I'll let you all get back to the original video. But I think overall that is pretty much covered this, going through both the 3-box strategy and also teaching you some smart money concepts and techniques that I use within my analysis. I hope this has helped. I hope this is a nice refresh from the last video we made on the 3-box strategy. So an updated version, throwing in a bit extra bits. I don't know why. I literally just picked a random market here, US dollar yen. Probably not the best market to give examples on, but at the end of the day, it's still showing that you can use this strategy on any market you would like, and it works. So make sure to take away from this video, even if you don't have the same technique, make sure you have a strict rule or strict criteria within your analysis, and then also having that strict criteria when it comes to entering in on the market. So my strict analysis is the fact that I need 1, impulsive wave, 2, point of interest, 3, Wyckoff and entry confirmation. So that's my 3 step analysis technique. And then when it comes to confirming an entry, I have another approach, which, as you remember, liquidity built up, high volume move to clear liquidity, and then change of character. So I have these set rules, this set list of criteria that must be met to try and remove any emotion from the process to ensure that there's a strict set of rules that must be followed, and therefore there can never be any deviation away from that. Without waffling on, I hope all of you have enjoyed this video. A huge thank you to lagfx as well for introducing this into the scene. This is my application of it. If you have any questions, make sure to let me know in the comments. If you're interested in seeing analysis from myself and LAGFX, as well as updates from us, make sure you join the Learning Lounge. The link is always in the description. Just a free Telegram group. Finally, the last thing, we have launched a free course over on the LAGFX website, which runs through all the beginnings of forex, what is forex, risk management, trading psychology, how to set up your trading platforms, all about LAGFX and myself and Luke. So go over, claim that free course, and start your forex journey today. But without further ado, thank you for watching, and we'll see you all next time in a new Learn to Trade video.